How bond pricing works. What's behind the yield? Today, I'm going to show you the simplest way to understand how bond pricing works. Or in other words, why does one bond yield more than another? And how is that amount determined? Throughout this video, I'm going to use the analogy of building a new car. With a car, you start with the base model. Then, as you add things like leather seats, upgraded wheels, or a bigger engine, it gets more expensive, right? Bond pricing works exactly like that. The base model is the Treasury curve, since Treasuries only have basic bond risks that apply to all bonds. For more on that, check out my video on what determines the shape of the yield curve. Here, we'll focus on different types of bonds at any one given maturity. For example, a 10-year Treasury bond, a 10-year corporate bond, a 10-year municipal bond, or muni, etc. And which maturity we choose doesn't matter because it works the same across the whole yield curve. If it's a US bond, its yield will never be below the yield of a Treasury bond with the same maturity. There are a few exceptions where the yield doesn't tell the whole story though. For example, you may choose a municipal bond with a lower yield because you know that later on, you'll pay less in taxes. For our purposes in this video, we'll use the 10-year Treasury bond as the base model. In this chart, you can see what a normal yield curve looks like. And at this point in time, the 10-year Treasury bond was paying you about 3%. With that as our baseline, other types of bonds offer investors extra compensation for each type of risk, like how a car buyer would pay extra for each option they added to the base model. Let's say you're buying a bond from Coca-Cola, a safe company. If they issued a 10-year bond, they might only have to pay a little more than 3%, maybe 3.5%, to reflect the risk that they might not pay you back. It's a low risk, so you get a low reward for it, like adding wheel locks to your car for $100. But nonetheless, that extra 0.5% is added on to the original yield. But what if the bond was also callable? Well, Coca-Cola would also have to pay extra for that. When a bond is callable, it means that at a certain period in the future, they have the option to give you all your money back instead of waiting the full 10 years. So you may be asking, why would they do that though? Well, because interest rates have gone down and they can now borrow new money for cheaper, paying less interest. It's like when you refinance your house at a lower rate to pay less interest. It's good for the borrower. In this case, Coca-Cola. But it's bad for the lender or bondholder, AKA you, because you thought you were going to keep enjoying that juicy interest rate for 5 more years. And now you have to buy a new bond out there that pays less. As a bond investor, that's more risk they need to compensate you for. Or put differently, as a borrower, that's an option that Coca-Cola has to pay extra for. So maybe a Treasury bond is paying 3%. A Coca-Cola bond would have to pay an extra 0.5% for the credit risk. So 3.5%. And a callable Coca-Cola bond would have to pay an extra 0.25% for the call risk, so 3.75%. Just like a car's final price is the base model plus all of its options, a bond's yield is the baseline Treasury yield plus more compensation for each risk. Just like not all options on a car cost the same amount, not all risk in bonds require the same amount of compensation. Bigger options on a car cost more and bigger risk in bonds pay you more. Imagine it's not a Coca-Cola bond, but instead it's a bond of an upstart tech company. Will that upstart tech company still be around in 10 years to pay you back? Maybe, but it's definitely not as likely as Coca-Cola. So the credit risk premium the tech company would have to pay would be higher. Maybe instead of the extra 0.5% Coca-Cola had to pay for their credit risk, the upstart tech company would have to pay an additional 5%. This gives the bond a yield of 8%. The 3% Treasury bond yield plus the 5% spread or premium for the credit risk. Each bond out there carries different kinds of risk: liquidity risk, prepayment risk, option risk, credit risk, etc. And the spread you get over treasuries is a reflection of compensation for each of these in the form of extra yield. Once you become a more seasoned bond investor, you can break down each risk a bond is exposed to and think to yourself, I'm not getting paid very much to take this risk. This bond isn't very attractive. Or maybe it's vice versa. This bond is priced like investors think they're gonna go out of business, and based on the strength of their balance sheet, I just don't think that's gonna happen. For the vast majority of you out there who aren't trying to analyze individual bonds, the most important lesson to take away from this is that there is no such thing as a free lunch. Sure, some bonds can offer a more compelling valuation than others, but in general, when one bond has a higher yield than another, it's because it has higher risk. I've seen so many investors pick funds based on yield without asking why the yield is so high, or hyper-focus on interest rate risk while totally ignoring all the other types of bond risk. That's a surefire way to get burned one day. And if this video gets even one person to ask the question of, why is this fund yielding so much more than the other ones? And then do a few minutes of digging and avoid a disaster for themselves, I've done my job. By the way, I started this channel to help transform Americans from beginner investors into expert investors. If you want to learn more about what that looks like, check out the link below called the 9 Habits of Successful Investors. The link is in the description. There's a saying that on YouTube, I give you what you want, but in the link below, I give you what you need. Thank you for watching, and I will see you in the next video.